session on our live webinar series Moneyfy Mantra, where we speak with industry experts on various personal finance topics to help educate our viewers on empowering them to manage their personal finance more efficiently. We've been seeing Sensex and Nifty hit, almost a all-time high over last 1 week, while mid caps are yet to follow. It's just there, about 8% down from an all-time high. We saw a lot of volatility this year. Now today, as we are here to demystify the mid cap segments, in the Indian stock markets, and to cover this topic, we have Mr. Chirag Mehta, head digital business, Canara Robeco AMC. Welcome, Chirag, to Moneyfy Mantra.
Thank you, Harsh. Thank you, Harsh, for having me here. It's an absolute pleasure to be interacting with you and the esteemed investors of Tata Capital.
Great. So, as we move forward to our topic, just a quick intro about Chirag. Chirag started his career with JP Morgan Chase, New York. He moved to India to set up the research desk for US fixed income markets in India for JP Morgan. Over the last 10, 12 years, Chirag has worked across various AMCs, which, to name a few, BNP Paribas, Principal Mutual Fund, Edelweiss Mutual Fund, and SBI. Chirag has been associated with Canara Robeco Mutual Fund over last 4 years. Now, before we jump to our topic today, let me give you some, details about our Moneyfy app by Tata Capital. Moneyfy covers, Moneyfy has all the financial products, listed on its platform. One can, start investing into mutual funds, create an SIP, and apply for a loan, apply for an insurance product on Moneyfy. We also have small cases, wherein if you already have a demat account, you can start buying small cases on Moneyfy, and if you don't have one, you can open one on Moneyfy. And we also have NPS for the retirement planning for our customers. So in case you want to download Moneyfy, we have given the link in the description, and please download and check it out. It's a wonderful app to manage your personal finance. And I would also request all our viewers to update comments on the chat window for any, if there are any questions, we will cover it towards the end of this session. So Chirag, to start with, what exactly are mid cap equity mutual funds?
So, Harsh, basically, SEBI has clearly defined what are mid-cap stocks. So, stocks which are ranked 101 to 250 in terms of total market cap, are called as mid-cap stocks. So, stocks ranked 1 to 100 are large cap stocks, 101 to 250 are mid-cap stocks, and 251 onwards are called small cap stocks. So, mid-cap funds basically are funds which has to necessarily invest at least 65% in the mid-cap stocks, and you're free to invest the remaining 30-35%, across large, mid, and small cap stocks. So that's what the technical definition of mid-cap funds are.
Yeah. So we've seen that mid-cap funds have generally outperformed the large cap funds, or the mid-cap segments in generally has outperformed the large cap segment. So is there any particular reason that mid caps tend to outperform large caps over a long period of time?
So there are multiple reasons, but I'll just highlight 2 or 3 main reasons. One, obviously, mid cap as a segment is slightly under researched and under discovered compared to the large cap stocks. So, for example, on an average, a large cap company, there are about 30 to 32 analysts covering each large cap company. Whereas when you come down to the mid cap segment, the number almost halves. So there are roughly about just 16 to 17 analysts, which are covering the mid cap segment for each company in mid cap segment. So it is slightly under researched, under discovered. So if you get the research right, if you get your timing right, and remain invested in the long term, you tend to enjoy the good run of capital appreciation in these stocks. Secondly, there are some unique sectors, of the economy which are available to invest only in the mid cap segment. For example, say air conditioner companies, footwear companies, railways, beverages. There's so many companies and sectors which are just available, for investment in mid cap segment. You don't have representation of the segment. So these are, I would say, the two primary reasons. One, the uniqueness of some of the sectors and companies which are available in the mid-cap segment, plus the segment being under researched and under discovered, by the sell side analyst, gives you an interesting proposition which kind of leads to good alpha generation over longer period of time compared to the large cap funds.
All right. So, is there any particular thing, if I want to invest today in a mid cap fund, which I should consider before, going ahead for investing into a mid cap fund?
Two things. Your investment horizon should be at least 5 years. We are not looking at investors who are looking to invest in 1 year, 2 year, 3 years, because, like I said, it's an under-researched thing. Sometimes the market takes time to recognize the stocks that you buy. So the investment horizon has to be at least 5 years. If you're considering to invest in mid-cap funds. Secondly, investors should be willing to digest some short-term volatility. Right, so there'll be some volatility, near-term volatility, in case the markets become too expensive, or there's some global events, which are impacting the Indian market. So you should be able to weather out the volatility, the near-term volatility, and stay invested, say, beyond 5 years. I would say these are two things in that you should keep in mind, before investing in mid-cap funds.
All right. So I think, the risk appetite of an investor should be adequate enough to absorb some short-term losses. Correct. So,
Absolutely.
you know, yeah, go ahead.
No, if I agree with you, you should be able to have that patience, where there could be some short-term volatility. There could also be cases where for your near-term returns could be negative. But if you have the patience, and if there's a track record that is already there of the mid-cap segment, that generally remain invested beyond 3 years and 5 years, then the chances of negative returns are almost zero.
Correct. So, there are a lot of other mutual funds which, cover mid cap as an investment theme within an overall portfolio. To name a few, we have flexi cap funds, we have multi cap funds investing in some of the mid caps. So, if I were to differentiate between a multi cap fund and a mid cap fund, what exactly would be the difference between both the funds?
So if you look at multi-caps as a fund, there are three core strategies: large, mid, and small cap, all three, right? There are 25% each in each of the market cap segment. Vis-a-vis in mid cap, you only have one core portfolio, which is a mid cap. So while there's a SEBI requirement of 65%, on an average, funds keep anywhere between 75 to 80% invested in the mid cap stocks. So I think the core strategy and the core portfolio of the mid cap, like I said, the key differentiator. In other funds, even in large and mid cap funds, for example, where mid caps form a substantial part, there we don't see generally funds go beyond say 45-50% mid cap allocation in the most bullish cases. So here you have a significant exposure. Here the fund managers are willing to take longer term bets, because the investor is coming with a 5-year horizon. There are certain companies that you might be just investing way ahead of the market. We might be able to identify certain companies before rest of the markets too. So these are the key differentiators in terms of the way an asset manager would look, while deploying their assets in the mid cap fund.
So, we know that, 100, 1 to 100, it's large cap, 101 to 250, it is mid cap, as you mentioned, and, beyond 250 is small cap. So, to create a mid cap portfolio, you have limited number of stocks. So does this create any, problem for the fund manager to create a portfolio?
Not really, Harsh. So if you see a typical mid cap fund, the average holdings are between 50 to 70 stocks. So there are 150 companies if you look at the mid cap index itself. And with the way the quality of the mid cap companies are improving, I think a good investment, and you have a investable universe of 80, 90 good stocks, which you can really invest in. So I really don't think so there is any dearth of investing ideas within the mid cap segment. Also, the liquidity of the segment has also improved significantly over years. Earlier it was an issue, where if you had a fund size of say 5,000, 7,000 crores, it would be a challenge to manage funds of that size. Now I think you have funds in the industry which are 15, 20,000 crores, and they'll still be able to manage very well. So I think, generating investing idea should not be a problem in mid cap segment.
Correct. So, we've seen, a lot of volatility in the market, and, some of the mid cap funds, if you were to, compare the topmost performing mid cap fund and the, bottommost performing mid cap fund in terms of the, 5-year returns or 3 years return, we see a lot of deviation. in the returns, while they both are in the same segment. So is there a problem with benchmarking the mid cap fund, in general?
So, Harsh, good question, and this is something that people should keep in also mind. Generally, mid-cap funds as well as small-cap funds are purely bottom-up portfolios. They are sector agnostic, and therefore, your allocation to sectors vis-a-vis the sectors which are there in the benchmark may not be the same, right? Unlike a typical large-cap fund or a flexi-cap fund, where your weights of sectors and stocks are very close to the benchmark weights, maybe barring a few percentage points. Mid-cap funds and small-cap funds typically are very sector agnostic. They are completely bottom-up portfolio, and therefore the weights in the portfolio may or may not be representative of the weights in the benchmark. Which is where you will see a huge deviation in terms of performance over the benchmark or below the benchmark based on how the fund manager got the stock selection right. Which is why stock selection becomes the key, on managing a mid-cap fund. And then I think if an AMC needs to have a strong in-house primary research, to ensure that you manage the funds efficiently. You're not short of ideas. You're not scratching your heads to deploy the money that keep getting into the funds. That is something that we have also built over a period of time to ensure that we have enough primary research so that the deployment can happen easily.
Correct. So it's very important that I think you choose the right fund for your investment, because even if you say select a fund which misses out on buying a particular script which has grown say 5x over last 2 years, then it may create a lot of deviation in the returns. Yeah. So we have seen that uh, you know liquidity issues in some of the small cap stocks, and not sure if we still have liquidity issues in terms of buying and selling mid cap stocks. So if I as an investor is investing into mid cap fund, will I face any liquidity issue in terms of buying or selling of my units?
Not at all, Harsh. In fact, the redemption payouts, etc., for a mutual fund is governed by SEBI. So typically in any equity fund, you get the redemption payouts on a T+3 basis. So this is means the most liquid segment, and which is why we also suggested a lot of the investors, if you want exposure to mid caps, mutual funds is the best route. It generally gives you good returns, market beating returns. At the same time, also gives you liquidity. Unless you're trying to do your own research and investing yourself in mid cap stocks, where, like you pointed out, sometimes liquidity may become an issue, especially when the markets are correcting and you really want to exit a position. So I think mutual funds would give you a good option, good liquidity. Anytime, generally when a redemption is put out, mutual funds are mandated to make a payout on T+3 basis. So I think it is the most liquid segment within the mid cap space compared to buying and selling your own mid cap holdings, especially in the markets where it's extremely volatile.
Correct. So what is the highlighting feature for if I am an investor, if I want to review, what is the main highlighting feature for a mid cap fund, which everyone should be aware about?
So it has a significant points. It's largely what we covered already that we discussed so far. But something like it has a good alpha generation capability over a longer period of time. Secondly, the general perception is that mid caps means there are higher possibility of losses. But the way the mid cap as a segment has evolved, the way the companies have improved their finances and their operating performance in the mid cap segment, the chances of losses have reduced significantly. The drawdowns is what we call technically. The drawdowns have come down significantly. So if you look at last 10-year performance, of a mid cap index itself, if you have to look at performance from say September 2013 till now, there are 0% chances where the mid cap index has given you negative return on a 5-year rolling return basis. On a 3-year rolling returns, there's still probably about 3 to 4% chances where you would have made negative returns, which is itself is very low. But on a 5-year basis, it has been almost 0%. So you hold your places, remain invested, stay put. There might be some near-term volatility, but the segment has grown so fantastically well. There are so many leaders available in the mid-cap segment. The quality of companies is good. It's no more a sector where you have a question mark on the quality of the company or the quality of the promoter. You don't have mid-cap companies closing down these days, which was the case probably 15, 20 years back. So mid-cap as a segment has evolved. It has generated significant alpha, historically over the last 15, 20 years in that segment. Volatility too, if you remain invested for 5 years, 7 years, there is not too much of a difference in terms of volatility between a mid-cap, as a segment vis-a-vis large cap as a segment. So on a long-term basis, you end up making good risk-adjusted returns, much better than the large caps, if you remain invested for that term. So be patient. There could be some bumpy rides, but those are purely short-term. Remain invested for a longer period of time, and there are quality mid-cap companies available. Where you can have easy nights. Where you don't spend sleepless nights in terms of the holdings you have. So I think it gives a good combination of large caps and small caps. Large caps typically you say that when you think of large caps, you think about stability, steadiness, visible growth, a continuous and consistent growth in terms of the financial performance. Plus, when you think of small caps, you think about promoter or entrepreneur-driven companies which can generate significant alpha over a longer period of time. I think mid cap is such a wonderful segment, gives a combination of both. There are companies which have become market leaders, which have the highest market share in their segment. You have a clear visibility in terms of their earnings growing over a longer period of time. Their growth or visibility is also there. They have a quality management in place, and obviously it has alpha generation capability as well. So mid caps, is a nice combination of features of large caps and small caps.
Yeah, fantastically put. Who are the typical type of investors who should consider mid cap funds to be included in their portfolio?
So first, I think because the potential that mid-cap has, I think mid-cap should be a part of the core portfolio for everyone. It's not a satellite strategy, it's a core portfolio. It should be part of the core portfolio of anyone's asset allocation. Secondly, like I said, people who have that ability to withstand volatility, have a slightly higher risk tolerance, to withstand the near-term volatility, and have the courage to tide over the market volatility over 3 years, 5 years. Are the someone who would recommend, especially I mean, we don't say that people who are retired, are close to retirement, if you have a risk appetite, if you have enough corpus built for yourself, then you may. But people who started to earn, people in the middle age, people in the accumulation phase, we believe that mid cap should be a part of your core portfolio.
Correct. So if I were to recommend how much of the allocation should be there in mid cap, would there be some rule in terms of the age, or if I'm an early investor, or in a very young age, I just started earning and started investing, should I allocate a higher part of my portfolio to mid cap funds?
So generally the rule that is followed is 100 minus your age should be your equity allocation, right? So assume that I start earning at 25, 100 minus 25, typically between 75 to 80 should be my equities allocation of my total investments. Within that, as you are younger, you should have a higher portion, to mid caps and smaller to the large cap segment. But as you grow in age, your risk profile also starts, kind of move away from aggressive to moderate to conservative. So your large cap allocation would become a significant portion, and mid cap would become a smaller portion. So I won't put a fixed percentage. It depends on individual's risk profile. But if you have to give me a profile of a person just starting to earn, I think I'll have a higher portion, invested in mid caps, and lower to large caps. And as I grow in age and start hitting the retirement age, say 40, 45, 50, I'll start reducing my mid cap exposure and increasing my large cap exposure.
Correct. So, Chirag, we have, since we are managing a platform, we have seen that a lot of customers investing in these mid and small cap funds for a very short period of time. They would invest if the markets are up 5 or 10%. They would want to book profit. Is this way of a strategy of what a retail investor generally tries to follow? Is it worth following, or the strategy should be still to hold your investments for a long period of time?
I think investing in long term should be the strategy for any individual investor. I think history is proven, and not just to Indian markets and global markets, nobody gets the timing call right every time, right? So especially when you try to time the markets, you have to get it right 2 times, right? Once ensuring that you're buying at the lower price, and secondly, exiting at the higher price. Now, for each trade, getting it right twice, it's a challenge. And like we have seen sometimes when the market's correct and you get stuck with the position, it kind of becomes a part of your legacy holdings. It just remains somewhere in your portfolio. You wait for liquid to come back someday, and exit. So it's instead of that, do your own research, remain invested. If you're not capable of doing your own research, there are so many good mid-cap funds available in the market which are professionally managed by the asset management companies. Remain invested in them. Remain invested there for 4 years, 5 years, 7 years, and you end up making very good returns. Probably something that no other asset class offers you, in terms of the risk return profile that the mid cap fund does. So 1 year, 2 years, I would say even 3 years is something that we don't recommend because mid caps can be volatile. And many times the alpha generation in the mid caps happens kind of back ended, because we discuss that a lot of the time the stocks are under research and under discovered. So markets take time to identify this as winners and start rewarding it. So I would, like I said, the starting point of the presentation that we would recommend at least 5 years as an investment horizon, while investing in mid caps.
Correct. So, Chirag, so we have upcoming NFO from Canara Robeco, which is about mid cap. So, would you want to tell us more about the NFO? To all our viewers.
Sure. Thanks, Harsh. So I'll just probably take about 5 to 7 minutes in describing the NFO. So we have already spoken about why should someone consider the mid caps as a part of the portfolio. So I'll not touch about that segment. I'll just talk about the Canara Robeco's expertise in managing equities. So Canara Robeco, friends, is the second oldest asset manager company in India after UTI. I'm not sure many of you are aware. It was set up as CanBank Mutual Fund in 1992. So if you look at our equity hybrid fund or balanced fund, it was launched in February 1993. So it's a 30-year-old balanced fund. Our ELSS fund was launched in March 1993. Again, a 30-year-old ELSS fund. So if you look at the asset management space, we have been an investor for almost last 30 years now. The AMC was just set up before the Harsh Mehta scam. So as an AMC, we have seen a Harsh Mehta scam, Ketan Parekh scam, dot-com bust, Lehman crisis, policy logjam, COVID, Russia, Ukraine, everything and all the bull rallies which happened in the interim. So what we have been able to do through our investing experience for the last 30 years is build a very comprehensive investment management and risk management process, which ensures that it covers most of the business cycles and what are the characteristics that each cycle has to offer. And we have tried to cover it through our robust investment management process as well as the risk management process. So we look at 5 things, if you ask me what do we look at when we invest in equities or companies, we look at 5 things, and only if the company meets these 5 things, do we consider that the company for investing. So first thing, the company should offer quality. Quality means quality of the business as well as the quality of the management. We say that, if you were to win a horse race, it's important to have a good horse, but it's equally important to have a good jockey. We believe the same is the case with businesses, that you need to have a good business and a good management which can run the good business. If one of them is not good, then chances of succeeding is very less. So first we look at quality of business and quality of the management. Secondly, we look at the growth factor. The company should give us strong visible growth. When we say visible growth, we talk about, again, long term, 3 years, 5 years, 10 years. We are not looking at companies, from a short term or punting perspective. That we look at 1 or 2 quarters growth. Returns acha gaya, the stock has been rewarded, move out. So we need to have that visible growth for long term, 5 years to 10 years, and the growth rate should be higher than its industry peers. So we are not looking at an average performance. We are looking at companies which are growing higher than the industry peers, as well as their growth rate is something that they can sustain over a longer period of time, say 5 years to 7 years. First is quality, second is growth, third is the company should be able to generate enough free cash flow for itself. So what happens when a company doesn't generate the cash flow from its own businesses? It's dependent too much on external funds for its growth. So every time the company wants to grow, every time the company wants to set up a facility, want to invest in its research, many times they are dependent always on the external funds. We really don't want that. We say if the business is good, if the management is good, the company should be able to generate enough cash flow from its core business that it can support its own growth. Fourth, we look at is the track record of the management and the ability of the management to take good capital allocation decision. Many times we see that companies are profitable, companies are generating good cash flows, but the redeployment of capital and profit is not very prudent. Just to give you an example, say for example, there might be a pharma company, which is very profitable, is having good cash flow, but the next all of a sudden starts buying real estate. Now, is it really prudent, for a pharma company to buy a real estate? Probably not. You may set up a separate company if you want to buy a real estate to do some investments, but the company should ideally be deploying its own assets, its own capital for the core growth of its business. So the capital allocation decision is something that we also evaluate, and the companies only if it has a good track record of capital allocation do we consider those companies. And finally, what we look at is, see, there are two types of financial risks in any company. One is the P&L risk and one is the balance sheet risk. So P&L risk is something that at the Canara Robeco we are willing to take, but not at all any kind of balance sheet risk. Again, just for the purpose of viewers, what is the P&L risk? So for example, currently we are witnessing very high inflation. The raw material cost or the input cost have raised significantly. So this year your profit might be slightly lower, compared to your historical average. But you have the business, you have the management in place, which will ensure that once the inflation subsides and you go back to a higher growth rate, you have that confidence. So it's a short-term P&L risk that you're taking. Compare that to a company, which is taking significant leverage on its balance sheet. You know, too much of loans sitting on its balance sheet, too short of working capital cycles, not taking the minority investors, very seriously. So if there's any kind of balance sheet risk which is existing on the company, then we ignore that. So 5 things I spoke about that we consider. One is the quality of the business and the quality of the management. Secondly, the visibility of the growth and growing at a higher rate compared to its industry peers. Thirdly, the company should be able to generate enough free cash flows from its own business that can support its own growth. Fourth, the company should have a good demonstrated track record of capital allocation. There should not be any misallocation decisions. And finally, at Canara Robeco, we are willing to take P&L risk for short term, but we don't take any balance sheet risk. So these are a few tick marks that look from an investment perspective, and then obviously you put the valuation filter and you see which is a better compared to the others. So and then we have a robust risk management process in place. Again, I just give you a perspective. If you're having a sports car, which can take a top speed of 300 kilometers per hour, as a driver, when would you have confidence to take your car to 300 kilometers per hour? Right? When you have the confidence in your braking system that if there's anything, if I hit the brakes, it will stop at the right time. We believe risk management does the same thing for the investment management process. The fund manager should have the comfort that, look, there's someone constantly watching the portfolio and the markets on a live basis. If something going wrong in certain pockets of the market, there's someone who is just flagging it off to us and ensuring that we take the right decisions. So that's what risk management has done. So at Canara Robeco, risk management is as equally important as compared to your investment management. So we have set up various limits within Canara Robeco. Just to give you a perspective, SEBI says in any fund you can go up to 10% in buying a single stock, right, of your scheme AUM. At Canara Robeco, if you're buying a mid-cap stock or a small-cap stock, we restrict that to 4% only at the time of buying. So you'll not see any stock any of our a mid-cap portfolio, small-cap portfolio exceeding 4% of the scheme AUM. Why we do that? We do that because we know when the markets dry up, the liquidity goes down significantly, and you'll end up having stocks, which you really don't want. Then you start accumulating. It becomes, a long tail for you. You're having too many stocks with 0.1% allocation, 0.5% allocation, and you continue through various cycles, right? So if you look at any of our Canara Robeco portfolio, and we've managed for equity funds, like I said, for more than 20 years now, we don't have a single legacy holdings, where you can say, probably this is a stock of the previous bull market and they could not sell it off. We don't have a single legacy portfolio, a legacy stock in any of our portfolio. So because of this strong, and thirdly, having our own independent primary research in place. We are not an AMC which is into an AUM chasing game. We believe that only and only if you believe we can do justice to our investors who come in at any point in time, do we launch a fund. So previous major NFO was way back in 2019 when we launched Canara Robeco Small Cap Fund in February 2019. At that time, we were roughly covering about 150 to 155 stocks on a primary research, where our own team was covering these stocks. That universe has increased to almost 280 stocks now. So there are 280 companies across the market cap segment where Canara Robeco's team is doing its own primary research. Now, this ensures that we are not short of ideas, something that we spoke about earlier, right? So if we keep getting money in this funds on an ongoing basis, we are not short of ideas in terms of where do we deploy this money. We really don't take cash calls, so we will not be sitting on cash for long. So setting up a comprehensive investment management process to last 30 years of experience, and having a very comprehensive and robust risk management process to ensure that the portfolios are always liquid, they're in a good shape, and it continues to deliver good and steady consistent returns over a longer period of time. And finally, having our own primary research to ensure that we are never short of ideas and where to deploy the money that we continuously keep getting. And through this process, of 3-4 things that we do, we have been able to establish track record for so many of our funds. So Flexi Cap Fund, for example, it's a 19-year-old fund. It was launched in 2003, so it will complete 20 years next year. Canara Robeco Emerging Equities Fund was launched in 2006, 2005 rather. So it's been a fund again in place for the last 17 years. A blue chip fund with a large cap fund was launched in 2010. So another fund with a 12 years track record. Equity hybrid fund assets also a 30-year track record. So we have funds, which demonstrated track record. We have been managing these funds. We have been managing these funds through various market cycles, and despite of all the market cycles, all our funds have been able to deliver good, market-beating returns across the period. So this is the reason why we believe that someone should look at Canara Robeco mid-cap fund because of its track record, because of processes that we have set in place. And something that we believe that we'll continue to do that. There is no exception allowed. So be it the head of investment or be it the junior most analyst, no one is allowed to make an exception to the investment process. Everyone has to follow the process to the T, just to ensure that you deliver consistency in returns. So this is what we do at Canara Robeco, and this is what we believe that as an investor, when you're investing in Canara Robeco, you can expect this from Canara Robeco. While investing. One final point, but to stop about Harsh, sorry to interrupt. It's also from a markets perspective. You just mentioned that probably mid caps is yet to make an all-time high. So I think mid caps as a segment of the last 12 to 15 months has seen a good time correction. While it might not have seen a significant price correction compared to what we have seen in the global markets, I think it has been a good time correction which has happened, right? So markets go through either price correction or time correction. So I think in case of mid caps, it has been more of a time correction which we have witnessed for the last 15 months. Now, during that 15 months, the corporate earnings have also picked up. It's first time after almost 12 to 13 years, we are seeing the EPS of the index growing by more than double digits. It's positive sign. What we also see good thing is that the bank credit also growing up. The previous 2 published numbers are showing the bank credit growth growing at more than 15%, which are good signs that at least the companies are back into the market. Banks are also willing to lend, and then these are some early green shoots of a long-term positive cycle for the market. So market, I think it's offering you a good entry point. Canara Robeco has set up a good investment process and a risk management process. It offers you a good track record, and I think if you have an investment horizon of 5-year plus, I think this is something that and all the investors should definitely consider investing in.
Correct. So Chirag, I just wanted to put the slide where we have the NFO period. The NFO has already started from 11th of November and will continue till November 25th. I think one more point for all our investors to make a note is Canara Robeco equity funds have been have been placed on the top quartile, I think, in most of the categories. Yeah. I think Canara Robeco small cap fund, large cap fund, and the flexi cap fund have been extremely doing well in terms of performance. And I think these are some of the 5-star rated
emerging equities fund, which is the largest fund.
Yeah,
it's a larger mid cap fund.
Correct. So, I think most of the equity funds managed by Canara Robeco today are, performing extremely well. And it is not just recent performance. It has been consistently performing well over last, I think last 4 to 5 years. Whenever I go and research about, the equity funds performance, I think Canara Robeco, most of the funds are on the top quartile. I think recently the small cap fund has, passed 5-year returns. I think
Clear returns, right? It's just compare
three-year
clear
returns.
returns.
Yes. So, I think some of the funds have been performing extremely well. I think this mid-cap fund, which has been launched, should be part of the portfolio if anyone is looking to invest in the mid-cap segment. So yeah, I think Chirag, that's about it for this session. I think we don't have any further questions from our audience. It was wonderful to have you on Moneyfy Mantra and cover the widely talked topic about mid-cap segment. Thanks Chirag for taking the time out and explaining our viewers about the mid-cap funds and taking us through the upcoming NFO.
Thanks Pratik for this opportunity, to interact with the investors of Tata Capital. Thank you very much.
Thanks Chirag. Have a great day. Thanks everyone for joining in.